look at the latest market news,
Yeah.
you see an asset in this just massive, brutal falling trend.
Oh, yeah. It's rough.
Right. I mean, it's seemingly flashing red sell signals for months on end. It looks like a falling knife.
Yeah, very sharp falling knife. Yeah.
Yeah, but then suddenly, out of nowhere, Wall Street analysts are calling it a strong buy, and, retail forums are lighting up calling it undervalued. So would you jump in? Or would you assume you're looking at a carefully laid trap?
I mean, that is the classic trader's dilemma right there.
Yeah.
You pull up the chart, you see this catastrophic drop from the all-time highs, and behavioral psychology just kicks right in.
Oh, completely. Your brain immediately starts whispering about a massive discount.
Exactly. It's hard to ignore.
But before we unpack whether this particular discount is real or just, a total illusion, let's get some quick house rules out of the way. If you want us to keep dissecting these wild financial anomalies and really pulling back the curtain on the mechanics of the market for you, hitting the like button and subscribing to the channel is, well, it's playfully compulsory at this point.
It really is.
And you absolutely must drop a comment with your real-time feedback on today's analysis as we go. Deal.
Sounds fair to me.
All right. So today's deep dive is zeroing in on a very specific, extremely volatile instrument. It's the Leveraged Shares 2X Long BMNR Daily ETF. Ticker symbol is BMNG.
Yeah, and it's a really complex instrument. It has this fascinating trail of order flow data and totally contradictory technical signals, not to mention the underlying macroeconomic variables.
It's a mess. But our mission today is to cut through that noise. We're going to figure out if this highly leveraged instrument is actually a hidden gem ready for a tactical breakout or a dangerous mirage just waiting to wipe out retail traders.
Because let's be real, the data on the surface is completely schizophrenic.
It really is. So to understand the current price action, we first have to look under the hood. Like, okay, let's unpack this. If you buy a regular stock, you own a fractional piece of a company, right? You have equity.
Right, you own a tiny sliver of the business.
But BMNG is not that. It's an actively managed, non-diversified leveraged fund. And it's designed to deliver 200%, so exactly 2 times, the daily performance of the common stock of Bitmine Immersion Technologies, which trades under the ticker BMNR.
Which means, right off the bat, we have to completely discard traditional fundamental analysis.
Yeah, throw it out the window.
Seriously. Normally when you analyze an asset, you open the quarterly or annual reports, you look at the income statement, you check the balance sheet for debt, you run a discounted cash flow model.
Right, you want to see revenue growth, operating margins, all that standard stuff.
Exactly. But you can't apply a corporate income statement to a leveraged ETF.
No, because it doesn't sell widgets. It doesn't have a factory.
Precisely. Its financials are fundamentally based on its net asset value, or NAV. And the engine driving that NAV isn't like a vault full of underlying stock. It's driven by swaps.
Swaps. Okay, yeah.
Yeah. The fund managers are entering into these institutional financial contracts with massive counterparties, usually tier 1 investment banks. And they do this to guarantee that daily 2x return.
Let's break down the mechanics of that swap for a second, just so everyone is clear. The ETF isn't just taking your money, buying BMNR stock on margin and calling it a day.
No, not at all.
They are actually paying a premium to a massive institution, essentially making a daily bet. The contract basically says, whatever the underlying Bitmine stock does today between the opening bell and the closing bell, you pay us double if it goes up, and we pay you double if it goes down.
Right. And that institutional counterparty isn't taking on that risk out of the goodness of their heart, obviously.
Obviously not.
They charge financing fees, and they usually hedge their own exposure in the background. So this introduces this layer of structural drag on the ETF.
Which brings up the core financial metrics, and these are wild. So this fund launched on October 27, 2025.
Very recently.
Super recently. And as of early April 2026, its assets under management, the AUM, is fluctuating right around $39.3 to $42.4 million.
Okay.
And the expense ratio, which covers the management fees and the cost of maintaining those rolling swap contracts we just talked about, that sits between 0.75% and 0.78%.
It's pretty steep.
It is. And if you are an investor looking for passive income, man, you are in the completely wrong neighborhood. The yield is a flat 0.00%.
Oh, absolutely. You don't buy a leveraged daily swap ETF for a steady quarterly dividend. That's just not what it's for.
No, definitely.
You buy it strictly for price action and day-to-day volatility capture.
And the price action here is staggering. I mean, if we look at the 52-week quote history, The range on this ETF goes from a launch high of $17.35 all the way down to a low of $1.
Wow.
Right now, it is sitting around $1.38 to $2 for 41 cents. So that means since its inception just a few months ago, the performance is down over 91%.
It's just a total collapse in face value. But honestly, the truly compelling part of this story isn't the drop itself.
No.
No, it's the sheer volume of buying and selling happening right now at these current lower levels. The order flow shows a 10-day average volume of 74.35 million shares.
Okay, let's just do the math on that because it's wild.
Yeah.
If the stock is trading around, say, $1.40, and 74 million shares are changing hands every single trading day,
Yeah.
that is roughly $100 million in daily trading volume. But wait, the total assets under management is only around $40 million?
Right. The entire value of the fund is turning over 2.5 times every single day.
That is insane liquidity.
It is. And this massive liquidity is fueled by immense intraday volatility, with the asset frequently swinging 7% to 15% in a single session.
Oh, wow.
Yeah, retail traders, algorithmic systems, and institutional market makers are getting in at 9:30 a.m. and closing out their positions completely by 4:00 p.m.
Which perfectly sets up the technical anomaly we need to discuss. I call this the short-term mirage. Because, think about it, with a performance history down 91% since its launch, how is it mathematically possible that automated technical analysis platforms are suddenly generating buy signals in the latest financial news?
It feels completely counterintuitive, right, to see green lights flashing on a chart that basically resembles a ski slope.
Yeah, it makes no sense. And I actually have to challenge the premise of some of the technical data being reported here.
Oh, really? How so?
So, a major factor driving these buy ratings is that the ETF is currently trading above its 200-day moving average.
Okay.
And that average is reported to be sitting at $1.37. The current price is $1.38. So the algorithms trigger a buy, right?
Yeah, that's standard technical theory.
But wait, the fund launched in late October 2025. We are in early April 2026.
Oh, I see where you're going.
There haven't been 200 trading days since inception. This fund hasn't existed long enough to even have a 200-day moving average.
That is such a fantastic catch. It is a massive structural flaw in how modern automated trading platforms operate.
Right. It's just phantom data.
Literally. Because when an algorithm demands a 200-day metric for a newly launched derivative, it doesn't just return an error code or a blank space, it backfills the data.
How does it do that?
It looks at the historical price of the underlying asset, so BMNR in this case, prior to October 2025, and then it applies the 2x daily leverage formula backwards in time to generate this synthetic simulated history for the ETF.
Wow. So these systematic trend-following funds and even retail traders using basic screeners, they're seeing this glowing green buy signal based on a 200-day line that is entirely a ghost. It's completely simulated.
It is phantom data, yeah. But the crazy part is it creates a self-fulfilling prophecy.
Because everyone acts on it.
Exactly. If enough algorithms buy the asset because it crossed this phantom line, the short-term momentum becomes very real. And, if we strip away the 200-day ghost data, we can actually look at the non-simulated indicators driving the recent 14% two-week rally.
Right. Let's look at the real numbers, the RSI and the AMSED. And this is where it gets super interesting for anyone who actively trades.
Mm-hmm.
The 14-day relative strength index is currently sitting between 48.5 and 55.8. That's dead neutral territory.
Yep.
But think about how wild that is for an asset down 91%. The look-back period for RSI is only 14 days, so this recent sideways consolidation and this minor 14% bump has completely flushed the algorithmic memory of that massive plunge from $17.
Yeah, from a purely mathematical standpoint, looking only at the last 2 weeks, the RSI algorithm sees a perfectly healthy, balanced market.
It has amnesia.
Totally blind to the historical cliff dive. It just indicates the asset has room to run in either direction without being stretched too thin.
And the MACD, the moving average convergence divergence, is actually flashing a positive momentum shift right now. The values are sitting between 0.013 and 0.030.
And to understand why that actually matters, we have to look at what the MACD is measuring. It tracks the spread between a short-term 12-day exponential moving average and a longer-term 26-day average. For months, that longer 26-day trend was just dragging the asset down relentlessly. But recently, the short-term 12-day momentum accelerated so rapidly that it actually crossed over the slower trend line.
Oh, a crossover.
Yeah. It's signaling a structural shift in velocity. The rate of descent hasn't just stalled, it is temporarily reversed.
Got it. And if you add in the 50-day moving average, which thankfully is a real non-simulated metric for this fund since we've actually had at least 50 trading days, it's also acting as a tailwind. because the current price of the $1.38 is sitting just above the 50-day line at $1.29.
So the tactical battleground is really clearly defined for traders right now. On the downside, the key support levels are at $1.36 and $1.37.
Okay, so if it stays above those.
As long as the price holds above those lines, the short-term bullish thesis remains completely intact. But on the upside, resistance sits immediately at $1.41 and then a harder ceiling at $1.38.
And beyond that.
Beyond that lies this massive, almost mythological long-term target of $2.76.
$2.76. Wow. Well, that structural setup is exactly why Wall Street analysts have upgraded this ETF from a sell to a buy. But, I mean, that upgrade comes with a massive asterisk.
A huge one.
The buy rating is strictly for a short-term outlook. They are basically just expecting the price to ping-pong between $1.28 and $1.48.
Which brings us to the great debate surrounding this ticker lately.
Yeah.
We have short-term buy signals wrapped inside a long-term chart that looks like a total disaster.
Yeah, a complete train wreck.
So if it's flashing short-term strength, is the stock truly undervalued at $1.38, or are retail traders stepping right into a highly engineered value trap?
I think we really have to talk about the psychology of the value trap here. I mean, try to put yourself in the shoes of an everyday retail trader.
Okay.
You open your brokerage app, you pull up the chart for BMNG, and the visual anchor point on that screen is the historical 52-week high of $17.35.
It's the first thing you see.
Right. Then you see the current price of $1.38. The human brain just hates that disparity. You look at that gap and the internal monologue starts. You're like, it's so cheap. If the underlying company just recovers a little bit, this ETF has to bounce back. If it just goes back to $5, I'm tripling my money.
And that cognitive bias anchoring to a past price is exactly what the mathematical mechanics of a leveraged ETF prey upon.
Really? Prey upon it how?
Because of a concept called volatility decay. That $17.35 high, it might as well exist in a different dimension. The fund doesn't remember its all-time high.
Okay, let's break down the brutal math of this decay, because this is the most important part. Why doesn't the ETF just bounce back to its previous highs if the underlying stock of Bitmine Immersion Technologies eventually recovers?
It all comes down to the necessity of daily rebalancing. Remember, this ETF is designed to give you 2x the return of BMNR for a single day.
Just one day.
Not for the week, not for the year, just today. Let's look at the underlying logic with some basic math.
Right, lay it on me.
Imagine an index starts at $100. The 2x leveraged ETF tracking it also starts at $100. On day one, the underlying index drops 10%. It goes down to $90.
Okay, and because of the leverage, the 2x ETF drops 20%, so it goes down to $80.
Exactly. Painful, but straightforward. Now, what happens when it recovers?
Well, on day two, the index needs to recover. To get from $90 back to its original $100, the index has to go up 11.1%.
Right. And let's say it does exactly that. So over the 2 days, the index is perfectly flat. It started at $100 and ended at $100.
Right.
Now, what happens to our 2x ETF? It goes up double that 11.1% gain. So it gains 22.2%.
Okay, so we take our $80 from day one, increase it by 22.2%, which brings us to $97.76.
Exactly. The underlying asset is perfectly flat. It's back at $100. But the leveraged ETF, because it rebalances daily and has to recover from a mathematically deeper hole, it lost over 2% of its total value.
Wow.
That is volatility decay.
Man. Now take that 2% drag and apply it over 6 months of aggressive chop, with the underlying asset swinging 7% to 15% every single day.
Yeah, it's brutal.
The compounding effect is devastating. The fund essentially eats its own capital just to maintain the leverage ratio. The mechanics dictate that the fund will lose value over time if the underlying stock trades sideways in a highly volatile manner.
And honestly, that's just the sideways risk. The downside directional risk is existential.
Meaning what exactly?
Because of the 2x leverage multiplier, if the underlying BMNR stock drops 50% during a single trading session.
Oh, the 2x ETF drops 100%.
Yes.
It is a total absolute wipeout of the principal. The fund literally goes to zero. It ceases to exist.
Yep. It doesn't matter what the MACD momentum looks like or if the RSI is in neutral territory. If the underlying asset gets cut in half in one day, the swaps implode and the game is over.
That is exactly why retail investors who treat this like a traditional buy-the-dip value stock often end up completely trapped. They are holding a decaying derivative while waiting for a fundamental recovery that the math won't even allow them to participate in fully. So, Knowing that the structural math is essentially fighting against the holder over the long term, let's map out the actual scenarios where this trade makes sense.
Okay.
If you are entering this tactical battleground, you really need to understand the macroeconomic forces driving the underlying stock. Let's outline the bull case versus the bear case.
Let's start with the best case recovery scenario, the bull case. To understand the upside of BMNG, you have to understand the business model of Bitmine Immersion Technologies. Their core operation is fundamentally tied to the Bitcoin network and the broader crypto ecosystem.
Right, and BMNR isn't just like buying Bitcoin, they are mining it. And specifically, they focus on immersion cooling technology, right?
Right.
Submerging ASIC mining rigs in dielectric fluid.
Exactly. It's designed to keep the hardware running significantly cooler, which allows them to overclock the machines, increase their hash rate, and theoretically operate way more efficiently than traditional air-cooled miners.
And efficiency is the absolute lifeblood of a Bitcoin miner, especially in a post-halving environment where the block rewards have just been slashed.
Yeah. Oh, without a doubt. If BMNR can prove that their immersion tech significantly lowers their energy costs per Bitcoin mined, their profit margins expand dramatically.
So if you're a trader eyeing that bull case, you're looking for a very specific alignment of catalysts. You need the price of Bitcoin to experience a massive, sustained upward surge.
Right. When Bitcoin spikes, mining becomes intensely profitable, and the underlying BMNR stock rallies.
And in a sustained, low volatility uptrend, the 2x leverage of BMNG actually flips from being a decay engine to a massive compounding multiplier. It accelerates those gains day over day.
Yeah, in that specific scenario, the current technical setup is perfectly primed. The price could easily blast through the immediate resistance at the $1.41, chew through the $1.48 level, and potentially make a violent run toward that long-term target of $2.76.
But the flip side of that coin is pretty grim. Walk me through the bear case and the potential for a continuation lower. What destroys the margins for an immersion miner?
Well, the bear case is this toxic combination of the extreme volatility decay we already discussed, compounded by hostile macroeconomic shifts in the real world.
Like energy costs.
Exactly. Bitcoin mining requires an immense continuous draw of electricity. If global energy prices spike, the cost to run those immersion rigs skyrockets.
And we also have to factor in the network difficulty and regulatory environments, too. I mean, if the Bitcoin hash rate gets too competitive, or if regional governments start cracking down on the carbon footprint and energy consumption of crypto miners, BMNR's operational costs go through the roof while their actual output shrinks.
Right. A steady drip of bad news, rising energy costs, or even just high daily volatility in the price of Bitcoin without a clear upward trend,
Yeah.
all of that will compress BMNR's margins.
And whatever pain the underlying stock feels, BMNG magnifies it by 2.
Yep, the ETF will simply grind down relentlessly until it approaches zero.
Which brings us to the ultimate outlook, and we have to explicitly separate this into 2 completely distinct timeframes.
Very important distinction.
For the short-term perspective, meaning intraday trading, holding for a few days, or maybe a couple of weeks at most, the sentiment is cautiously bullish. Analysts see a technical breakout from a falling trend, supported by those moving average crossovers. They expect violent tradable price fluctuations between $1.28 and $1.48.
Basically, it is a highly volatile playground for active day traders who are managing really tight stop losses.
Right. But if we transition to a medium to long-term outlook, the perspective completely inverts. It is intensely, undeniably bearish.
Oh, entirely. Due to the daily rebalancing mechanics, the cost of the underlying swaps, and the inescapable math of leverage decay we just talked about, this instrument is explicitly deemed unsuitable for long-term holding.
And honestly, this feels like the exact right moment for a mandatory, loud and clear disclaimer. We're analyzing the mechanics, the technical data, and the market structure behind these assets, but absolutely no financial advice is being given here today.
We cannot emphasize that enough. If we synthesize everything we've uncovered, the swap mechanics, the massive daily turnover, the ghost data driving the algorithms, and the brutal math of volatility decay, the ultimate takeaway is really clear.
BMNG is not an investment vehicle.
No, it is not. It is a highly calibrated, highly dangerous tool for capturing daily crypto volatility. It is a financial scalpel.
I love that analogy. You can use a scalpel to execute a precise, profitable surgical operation on a Tuesday morning. But you do not buy a scalpel and just leave it sitting in your pocket for a year. Eventually, it is going to cut you.
That's spot on. And the data proves that out. The 91% drop isn't an accident. It's the structural reality of the instrument over time.
So as we wrap up this analysis, I want to leave you with a lingering, somewhat provocative thought to ponder on your own. We spent a lot of time today breaking down the math of volatility decay. We know that daily rebalancing essentially guarantees that highly volatile leveraged funds like this will mathematically march towards zero over a long enough timeline.
It is built into the design.
Right. And yet, the order flow shows 74 million shares changing hands. Every single day, over $100 million is being traded on this single ticker.
It's unbelievable volume.
So if the instrument is structurally engineered to decay over time, who is actually on the winning side of all that volume?
That is the million-dollar question.
Are retail day traders truly fast enough to outsmart the decay and extract daily profits? Or are the institutions, the massive investment banks writing those swap contracts and collecting the premiums, the only real winners in this casino?
Something to think about.
Definitely think about who is taking the other side of your trade the next time you see a 91% discount on a leveraged ETF. Thank you so much for joining us on this deep dive. We'll catch you on the next one.